Legacies across the Pacific, smart strategies for Australian estates with US beneficiaries. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia. So glad you could join me here today. Okay, so just a couple of things to mention before today's presentation. This does not constitute personal financial tax or investment advice. If you are a client of mine, and we do have a number of clients on today's call, that advice is delivered in our private consultations. This is general information only, and so please do not take action based upon what you see here today, despite this information being sourced from reliable and authoritative information sources. I should mention our YouTube channel. The subscribers there have really picked up in recent times. Last month's topic to do with moving your US retirement accounts to Australia, always a favorite topic. Couple hundred registrants for that webinar. That's available there as well. I've got more than, well, you can see there, no need to say more than, because it says right there, 64 videos available. So feel free to consider subscribing there if you'd like. If you're unfamiliar with me and where I come from in providing this advice, really, I became a cross-border advisor because that was my situation. I moved to the US as a tri-citizen back in 2005. I lived there for 20 years. I then moved back to Australia permanently as of January this year, with a few years of alternating between the two countries. So this is an expertise that I've honed over the past decade. I also happen to be the executive director of the Global Financial Planning Institute, where I teach other advisors on what they need to know in cross-border planning. And you can see the rest of my bio right there. We work with Australian business owners. We work with folks planning their return from the US back to Australia, or Americans in Australia who have ongoing US investment needs, such as with 401ks, IRAs, that kind of deceased estates, that sort of thing. So you can see the kinds of example clients and outcomes that we've achieved right here. All right, so getting into today's presentation, there is a lot to cover. There's a lot of introductory concepts that we need to go through in order to make these comparisons before getting to actionable advice. So first, I'll start with what are transfer taxes, because that's the broad category of taxes that you find estate taxes and inheritance taxes classified as. Next, we'll be comparing and contrasting the US and Australia and how they tax estates. I have to define what the word situs means. We did see this 2 months ago, so a lot of similarities in the format of this presentation, but also many differences as well. The fifth point, we'll be looking at strategic estate planning for US beneficiaries of Australian trusts. Next, issues with non-resident beneficiaries of Australian trusts. That's to do with non-resident beneficiaries of testamentary trusts. Then I'll run through a checklist for executors and advisors. I think that's going to be a very helpful resource. And then lastly, practical difficulties Americans face distributing Australian estates. I have a goal of turning today's presentation into a white paper, because I think there really is enough here to warrant a white paper. In any case, let's get into it. And by the way, I hope you also, those folks tuning in from Brisbane, I hope you survived that mini cyclone on Sunday evening. It was pretty hair-raising over here. We had our mobile phone network knocked out, as well as the internet, the cable internet as well. So it was an unwelcome weather event, that's for sure. So just to be clear on who and what today's presentation is addressed at and what it's about, we're talking about Australian property and estates with US beneficiaries, if that wasn't already clear. These other permutations have been spoken about at other times. Okay, so transfer taxes, what are they? Transfer taxes are levies or taxes imposed on the conveyance of property from one person to another. And you can see some examples of this. Stamp duties, my favorite or least favorite example of this in Australia. There's the US federal estate tax, there's gift taxes in the US, and there's generation skipping taxes also in the US. So Australia gets away from it being described as having a death tax, that is estate or inheritance, and that's simply because they tax transfers differently, and it's I think it gives them better PR. So the Heritage Foundation and such places in the US that are Grover Norquist and so forth that are all about anti-tax no matter what, especially estate taxes. This kind of results in a similar outcome. It just sounds better because we're not taxing the event of death, which sounds inherently unfair. Why should there be a tax at death of someone? Instead, they're taxing the transfer of the asset. Okay. So the Australian estate tax system, as I mentioned, no estate tax itself does. They last abolished a state estate tax in Queensland in 1979 under Sir Joh Bjelke-Petersen. Income tax applies post-sale in Australia. So there are a couple of particular assets that can transfer without a tax impact, like superannuation for tax dependents, and I'll define that in a little bit. Primary residence, also, if that doesn't necessarily need to go to a tax dependent. Excuse me, that's a typo there, so we can delete that in fact, I'm going to do that right this second, just because I hate to see something inaccurate going up there. Primary residence. Okay, and then we're going to go back to presentation mode. Okay, primary residence and pre-CGT assets. So those acquired before September 20th, 1985. An important difference with Australia is Australia does not provide a step up in basis for investment assets, unlike the US. One of the go-to strategies in the US, especially with investment type assets, not retirement accounts, but we're talking investment properties or stocks, is just leave it and it'll get a step in basis for your heirs. And that way you need not leave a tip to Donald Trump and the IRS. It's a clever way of just saving taxes. No such opportunity for that kind of planning in Australia, because the way Australia would tax that is simply when the deceased passes on, the beneficiary, depending on whether they're an Australian tax resident or not, is either going to inherit that asset and have the same basis, the original cost basis of the asset, or trigger capital event K3 for non-resident beneficiaries. And we'll talk about that because there's a lot of detail to get into there. Okay, so if we were to summarize the Australian estate tax system, not that there is one, as I've already mentioned, the way it processes upon the death of somebody is assets either flow directly to beneficiaries or they're dealt with at the trust level. So the deceased estate trust assets are temporarily held in this deceased estate trust. It's managed by the executor. Income earned in the trust is generally taxed at individual rates for the beneficiaries during the administration of the estate. It has oversight from the ATO, and there's no reporting or tax for recipients quite yet, for domestic recipients, of course. Okay. You'll note there's the important difference right there, underlined and italicized. Taxation occurs only on the realization of assets. Now, that's fundamentally different for non-resident beneficiaries. If you're overseas, the ATO they've got a long arm and they're going to reach out and they're going to tax you before they lose the ability to do that. So as part of the settlement of the estate, this capital gains event K3, they're going to apply that tax beforehand. So there's no way the ATO is not getting their bite. So more Australian inheritance concepts. I'm going to define situs in a moment. I think it's a pretty simple concept. It's Latin for site or location. In Australia, they don't use that term situs so much. They refer to this concept of taxable Australian property. Some examples of taxable Australian property would be real estate, be it one's primary residence or investment real estate. It's tangible physical property that is absolutely located in Australia. Superannuation is another example of taxable Australian property. And a stock portfolio is Not necessarily taxable Australian property, but it does have this capital gains event K3 apply to it. The timing of the transfer. So I think the best example of that is the primary residence. If that transfer takes place within 2 years of the deceased passing, then that can be tax-free. If it's longer than that, then there could be a partial exemption or no exemption whatsoever, depending on the time period. The tax residence of the beneficiary, I've already alluded to this a number of times. Australia applies differing tax treatment depending on whether the beneficiary is an Australian tax resident or not. So comparing the Australian system to the US system, the US has a federal estate tax system where upon death, someone's total estate is added up. If it's in excess of 13.99 million in today's dollars, remember there's spousal portability, meaning if you're married, then we can double that exemption. So that gets up to 27.98 million in 2025, rising to 15 million per person, 30 million per couple next year in 2026. Now that has been made permanent. I used to have a little asterisk that hung over that because what happened is the Tax Cuts and Jobs Act of 2017 made an extension until 2025 of these higher amounts, but now the so-called One Big Beautiful Bill Act has made that estate tax exemption permanent. So one does need to be of a relatively high net worth to even worry about having a US estate tax situation in the first place. Depending on what state you're in the US, there may also be state inheritance taxes. There is, on the US side, there is a step up, as I mentioned before, in basis on inherited investment assets and that portability, as I also mentioned. So here's a nice table that compares the two systems succinctly. So Australian, we don't have any estate or inheritance tax. The US obviously does, as I just mentioned. Capital gains on inheritance, well, no, it's not taxed at the point of inheritance. It's taxed at the ultimate point of sale in Australia, whereas in the US you get that step up in basis. The taxing authority is obviously going to be the difference between the ATO versus the IRS. Portability of exemption doesn't really apply in the US. It now exists between spouses. However, there are some trusts that still make a lot of sense to set up simply to get the full step up in basis of all assets between spouses. State level tax, not a thing in Australia, can be a thing in the US depending on where you are. I used to live in Minnesota, and Minnesota has a state inheritance tax. I think it's 3.8 of that number. It's been a while since I looked at it, but it's above 3.8 million and it's 8%, as I recall. I'm sure someone's just about to chat in, actually. You're wrong, actually, it's 3.5 or it's 3 or whatever. But in any case, this does happen. Karen writes in, does the step up apply to any US benefit? Yes, it does. There's no class of US beneficiary that it wouldn't apply to, but Karen, this is where cross-border planning gets so complicated. As you'll see in an example I have coming up with a US resident living in New Zealand or a US resident living in Australia. So the US provides the step up in basis, but that doesn't mean that the country that a US tax resident living in, assuming it's not the US, also does. So we've got to compare what are your total tax obligations between the US and the foreign country that you're in. But simply put, if you're in the US, then there are no different classes of beneficiaries that would not enjoy that step up in basis. Deceased estate trust. So that's a uniquely Australian thing when compared between the two. And that's great, as I'll mention a little bit later. That's wonderful where a beneficiary may be an older adult, perhaps they're retired, they have the ability to return to Australia. They can, obviously no one knows quite when they're going to meet their maker or when their parents are going to meet their maker. And so that gives you some time to pack up, move back to Australia, establish Australian tax residency, and avoid all the worst tax impacts of being a foreign beneficiary. However, not too many people have that flexibility. Reporting requirements, really on the Australian side, it's on the tax realization event. and in the US, it's on the estate value at death. So situs of an asset, as I've already alluded to, that's a fairly straightforward concept. It refers to where an asset is deemed to be located. And you would think at first glance that this is pretty obvious, right? You know, if you own a home in Brisbane or Sydney, you're not going to be confused as to which country probably has taxing rights on something like that. But it gets tricky when we're talking about intangible assets, or what if you own an ETF or cash in the bank or life insurance? Where is the situs of these assets deemed to be? So this is a slide taken from the presentation 2 months ago, where we're talking about what's US situs and what's non-US situs. I included this because I think it has relevance. Even though we're talking about Australian estates, there still could be the example of an Australian estate with US assets. And in fact, we see that a lot with our clients, where they may have a US IRA or some other asset that they want to keep in the US that could very well be deemed to be US situs. I'm going to refer you back to that presentation from 2 months ago, because there's a formula that applies for determining how much of the estate tax exemption an Australian tax resident enjoys. You've got to be looking at a fairly high amount of assets held in the US before you have to worry about that. But nevertheless, for completeness, I would say check out that other presentation. Jenny, good to see you. Hope you're well. Ashley, I believe that in Australia you can leave assets in a testamentary trust for up to 80 years. By golly, what a good point. And Jenny, we actually have a section coming up on exactly that. And you're right, but it's not as simple as that. If you had US beneficiaries, in fact, you could cause a tax nightmare if you were to do precisely that, leave assets in a testamentary trust. Okay, so this is where I think the bulk of today's attention is going to be focused on, is getting clear on the different types of tax treatment that apply as per the tax asset class or category in this case. So the primary residence, I think I've done a fairly detailed example right here. Deceased, if mum, dad, grandma, whoever acquired the property before the 20th of September 85, that was before the CGT system even came into effect, it's automatically exempt regardless of use. There's no CGT applied, even if the property was rented out. Now, I had a former client up in Cairns who was using his house, lovely house. I actually visited him coincidentally at his house, which is something that happens from time to time. And it so happened that his wife was running an Airbnb out of the house. And you can probably tell where I'm going to go with this. This is going to affect the estate tax or the estate taxation of the house upon their passing, because it's not used exclusively as a primary residence. What if, like in 95% of other instances, the deceased acquired the property after the 20th of September 1985? Isn't that, it's a funny date. It's 40 years and what's that, about 36 days ago. If someone did acquire it since then it can't have been used to produce income. As I mentioned, that example of the former client, that could really throw a wrench in there. There is a 2-year rule, however, for the beneficiary or the receipt of a primary residence, and that is the beneficiary has 2 years from the date of death to sell the property and receive a full capital gains tax exemption. The commissioner has discretion to extend that, but this is going to be pretty tricky for someone who is living abroad. Excuse me, sorry, never mind that statement. That would be true also in the case of someone living abroad. The primary residence would, in the US in particular, the primary residence would still be tax-free. Okay, what about investment property? There's quite a distinction to be made here. For investment property, again, remember the ATO, they never ever miss out on their assessment, their taxable amount that they want. So as of this year, they changed the rules. There's now a 15% foreign resident capital gain withholding tax that applies on the sale of the property. So if the owners are deemed to be foreign residents, then no matter what, the ATO is getting in there and getting their 15% from the sale of that property on the capital gains, that is. It now applies to all property transactions. Buyer must withhold remit to the ATO. Property, of course, is citist in Australia. It's taxable Australian property. Therefore, in US beneficiary may continue to own taxable Australian property even as a non-resident, but highly taxed. And I feel I'm on a mission. I hope you'll help me in this mission and get the word out there that owning Australian property as a non-resident is a shocking idea. From if your intention is to make money and that's how you're doing it, it's a bad idea, because the way that investment real estate is taxed as a non-resident is terrible. Any income is taxed at 30% from the very first dollar, and you've lost your you've lost your capital gains exemption as of 2012. So 100% of the gain is taxable at ordinary income rates. So we're hitting $190,000, 45% plus the Medicare levy. If you've got a gain of that amount, and any income is taxed at 30% from the first dollar. So really terrible tax impact for investment property. And as I just mentioned, 30% of the first dollar of income, must file Australian tax return as a non-resident. So now you've got to be worried about doing taxes every 6 months if you own Australian property. A lot of people end up buying Australian property because they think it's a clever hedge before they move back. And that might be true. I think if it was shortly before you move back, but longer term, there's no question we've seen equities over the course of the last 100 years vastly outperform real estate. My advice would be, actually, you'd want to continue staying in the stock market, assuming your timeframes are long enough. Short term, I would suggest caution. But if you're talking about moving back to Australia in 10 or 20 years, I was speaking with someone recently where that had been exactly their plan. They purchased decades ago with that in mind. It's going to have an appalling tax treatment, because now all the gain on that property purchased 20 years ago is taxed at ordinary income rates, when they could have held capital gain assets in a stock account, used the exact same equity to buy shares in the S&P, and it would have probably tripled in that period of time, and then they'd owe 15% capital gains tax on that, or possibly better if they moved back to Australia and were able to surrender their US tax residency without incurring an exit tax, of which I've spoken about that many times before, including at the beginning of the year. That was the last time I updated the exit tax situation. Karen writes, the examples you were giving are for non-residents of Australia. Correct. Yep, that's right. Okay, where are we here? On sale capital gain is taxed in both countries. Australia's rate is going to be higher, and the worst case scenario, this is the absolute worst case scenario that I could imagine, is not only are you getting taxed at the non-resident rates in Australia, but also you could be subject to state income tax in the US as well. If you were in California or New York, very high state income taxes. So you could possibly be, depending on the magnitude of the gain and your facts and circumstances, in a 60+% marginal bracket because you own investment real estate in Australia. Okay, here is a pretty detailed flow chart just talking about the taxation of Australian real estate. So did the individual pass away? Well, we hope that someone has settled their estate from 40 years ago. So was the property originally purchased before okay, if it was, yes, then that's exempt. If it wasn't, no. Was the property inherited after 20th January 1996? Yes. Immediately before their death, was the property used to produce income? No, because primary residences, by and large, people aren't renting them out. And if they were, I might consider take a look at the super downsizer contribution that was recently made available. Was the property disposed of within 2 years of the date of death? Yes, it was. Congratulations, that's fully tax exempt. Let's move on. Shares and funds, so otherwise known as brokerage accounts. This is interesting because it brings up another couple of US tax concepts, such as PFICs, passive foreign investment companies, of which I've written a white paper that's available on my website talking about this, but we'll get to that in a moment. So yes, the US provides a step up in basis on the Australian holdings, but Australia, remember, they're not going to miss out on their bite of the cherry. And so this capital gains events K3 would apply. And so the amount received is going to be something less the tax already taken. Is the deceased estate, or was the deceased estate holding what would the US would deem to be PFICs? That is any kind of managed account. Is it a unit trust, an exchange traded fund, what they call managed fund in Australia, a limited partnership, an investment property held through some sort of company entity? If it is anything like that, it is bad news when received by a US beneficiary, even if they live in Australia. Why? Because of PFIC taxes. PFICs are a nightmare. In most instances, conveniently, although one's got to be careful what they say. The filing of the Form 8621, which is the form needed to comply with PFICs, is just as bad as the tax itself, and the tax is pretty bad. Also, they say it takes, I think it's 10 hours of prep time per PFIC. So to have any PFICs in your portfolio is going to massively add to the cost of your US tax return. So there's an administrative cost and there's a practical cost with the tax that actually applies to the PFIC. So that's no good at all. If an American citizen inherits an amount over 100,000 US dollars, Form 3520 is going to need to be filed. But if her shares, to Jenny's point earlier, if shares are held in Australian testamentary trust, different rules apply. Okay, let's talk about this capital event K3, as I've mentioned it a number of times. What is it? Well, it's a capital gains tax event that Australia applies to the deceased. They're going to treat the deceased as an Australian tax resident just before death. A non-resident beneficiary inherits an asset. Let's say they inherit shares in this fantastic managed fund that mum or dad had back in Australia, held outside of super. Remember, this is the difference here. We're not talking about superannuation. We're talking about investment assets held outside of superannuation. The asset is not taxable Australian property. Goes back to my point earlier about situs. Not entirely clear quite where this is deemed to be located, but it's not Australian situs property. Whereas real property is, so K3 doesn't apply to real estate. When does CGT event K3 occur? Happens just before the deceased's death, triggered when the beneficiary becomes absolutely entitled to the asset. This may be before actual legal transfer occurs, and then the capital gain or loss is included in the deceased's final tax return. The estate pays the tax. Remember, ATO, they ain't going to miss out on their taxation. So they're taking it from the legal personal representative of the estate. So there's no way that this money could leave Australia and the ATO miss out. It's not especially complicated how this tax works. It's essentially as if the estate sold it, they're taxed at the resident rate. So it's not a punitively high rate of tax. It's just taxed. It's as if the estate sold that asset for the purpose of a foreign beneficiary. So Cameron here passes away and leaves his estate to his two children, Frank, who's an Australian resident only, and Eva, who's a US tax resident living in New Zealand for the past 30 years. Cameron's estate consists of $200,000 of cash and shares with $200,000 with a basis of 120, split evenly between the two kids. So each child will get $100,000 of cash and $100,000 of stocks. In Eva's case, capital event K3 is triggered. Why? Because she is not an Australian tax resident. She's going to have a capital gain of $40,000. Remember, this is half of the $200,000. So 100,000 divided by the cost basis of 120. So half of 120 is 60. So she's got a $40,000 capital gain. Before she gets a penny in her pocket, the ATO has already reached out and taxed her $9,000 that she is going to, or the estate would have paid before she even receives it. So while the US may have stepped up the basis, the US isn't going to tax it. Australia already has. So the net effect isn't as different as you might think. So Frank inherits the shares with no tax paid on it. All right, that's good for him. He doesn't have the inconvenience or hassle, but he didn't get a step up in basis. So he's got dad's $60,000 basis. So whenever he sells it in the future, whenever that may be, he's still paying taxes of the same amount. It's just that Eva has had, you could think of it as a basis reset in a way. So her basis is now reset to $100,000. She's paid the appropriate tax, but that's capital event K3 and how that works. Let's talk about super next. Okay, so much to my chagrin, the IRS does not recognize Australian superannuation as equivalent to a US qualified retirement account for non-residents. In fact, I just did a presentation on this very topic earlier today for the GFP Institute, and it turns out that there's only one qualified retirement account transfer that I'm aware of in the world, and that's from the UK to Australia, possibly also from the UK to the US with their QROPS program. It's still not that good. In fact, I would say that a quote unquote non-qualified distribution of a US retirement account to a non-US tax resident in Australia, utilizing the Australia-US tax treaty, gets a much better outcome than what the quote unquote qualified treatment of a QROPS transfer does. But let's not digress. Okay, superannuation held by Australian resident may be treated as a foreign grantor trust. That's bad news for the American. A PFIC, we've already been through that. That's bad news too. And death benefit distributions, likely taxable income to the US beneficiary if held within super. That's not the case if the life insurance is held outside of super. Okay, so the critical planning point here is that super can create the worst possible tax outcome for a US beneficiary because it's taxed in Australia up to 17%, 15% plus 2% Medicare levy, and as high as 37% plus state tax wherever you may be located in the US as well. So super is super bad as an inheritance asset. Easily dealt with, by the way, assuming one has multiple beneficiaries in their estate. That is, you would want the super to go to the Australian beneficiary and the what? The primary residence to go to the non-beneficiary because of the 2-year CGT exemption there. So but there's plenty of equalization to be done elsewhere. So the non-tax dependent beneficiary in Australia is still going to pay that 17%, but that's a lot better than 50 or 60% when you stack on the US taxes as well. Okay, moving, actually, sorry, just back up a step here. Okay, yeah, I'm sorry. I think we went through super a little bit too quickly. Somehow, okay, Australian shares. Then we're on to super. This is, I think I skipped this slide, excuse me. So Australian taxation, they determine whether you're a tax dependent for the receipt of that super amount. So if you are a spouse or a financially dependent child, almost always under the age of 18, or in some kind of de facto interdependent relationship, then you may inherit that super account tax-free. Otherwise, that 15% applies. Excuse me, if you're an adult child living overseas, it is inconceivable, not impossible, but practically inconceivable that you would be deemed as a financial dependent upon the deceased back in Australia. So non-dependent beneficiaries are paying tax on the taxable component, of course. They're not paying it on non-concessional contributions, which is the non-taxable component. The chat's come in from Brian. Is the super problem overcome if it goes to the deceased estate, then on to the recipient? No, it's not, because it comes back to this point to do with the tax dependent. Good question, Brian. That does solve issues in other circumstances, but in this with super, it does not. So super, if you've got a way of having a non Australian resident be the beneficiary of accounts other than, excuse me, you do not want them to receive superannuation because of the aforementioned tax impact. Ron's wrote in a Q&A, when inheriting a home, if the home is going to if the home is going to both a non-tax resident and a tax resident, then the 15% tax resident is not required. I think that's right for the primary. Yeah, I get what you mean. I think that's true for you say a home could be an investment property, but I think you mean primary residence. I think what you're saying is correct. Yeah. Very good. All right. Well, I'm going to call that answered and get back to presentation. A couple more chats have come in. Andrew's written, can I just clarify, what if the deceased estate closes the super account, realizing its value is cash? Well, I'm not gonna hazard a guess on that one. I don't know. I'm sure someone else might know the answer to that. Jenny comes to mind as someone who could answer that one. I don't know if that's possible or not. My gut would tell me it's not possible, but that may not be the case. So, and then what if in pension status already? It doesn't matter. It's Karen. It would still be split between where the contributions came from. Okay, in Ron's writing, just to be clear, the 15% withholding doesn't mean that the tax is owed. Correct. You have to fight the ATO to get it back. I'm not so sure on that either. I would think with the primary residence that it wouldn't apply at all. Jenny writes in here, Jenny is a CPA. I think if you are in pension phase, you can pull it out and then recontribute as a non-concessional component. Okay, so there are some questions I don't have the answers to there to do with super specifically. Can the estate distribute that to itself and then just distribute cash back to beneficiaries? Certainly overseas beneficiaries, that would be a good way to go. And then what's the situation with super already in the distribution phase, in the pension phase? How is that taxed? I'm inclined, I double check this, Karen, but I'm inclined to think they still revert back to what component was what, and then tax it on a pro rata basis. Okay, so moving on here. So, okay, super. We went through this a moment ago. I still have these Q&As here. I'm going to get rid of those so that they disappear and I can focus on the presentation at hand. Okay, next, Jenny, Australian testamentary trusts. So they're commonly used for asset protection, for tax-effective income streaming for Australian beneficiaries, I might add. But for the US side of things, it can create a nightmare. And you would not want to see this. You would not want to see assets to be distributed to a US beneficiary inside an Australian testamentary trust. Why? Because it's going to attract foreign non-grantor trust treatment, which could result in the trust taxed, well, which will result in the trust being taxed as a separate entity. Accumulated distributions are subject to throwback tax rules. That's really where I meet the limit of my knowledge. I've heard of throwback tax for years from estate planners, but all I know is that it's not good and you don't want it, and you get taxed on previous distributions, which is very, very bad. Ordinary income rates up to 37%. Capital gains lose preferential treatment and get taxed at ordinary income rates, and then you're looking at your 3520, 3520A filings. So no good. Mary has asked here, at some point, could you address leaving some or all of your assets to charities and nonprofits? I have US and New Zealand citizenship, but resident in US. Australian assets are inherited from parents who lived in Australia, and I just left them there in stocks and CDs. Mary, as much as I would like to, I cannot do that. That is considered personal advice. And that's something that I would provide to a client. So unfortunately, that is not. The rest of these questions are more in the abstract. They're questions about facts. They're not questions to do with specific personal circumstances. To do with PFIX, I should mention I actually have written a white paper on this topic. So Here are some of the other complications that come up with testamentary trusts. The assets held are deemed or can be deemed to be PFICs. And then on the Australian side, there's also 99B issues as well. So all in all, this is a complete disaster. You would not want to have US beneficiaries. Remember, even if they're living in Australia, they may seem like Australian beneficiaries, but it's the US and that awful savings clause in the tax treaty that means that no matter where an American tax resident is, Antarctica, Zimbabwe, or anywhere in between, they're always a US tax resident. Okay, and lastly, sorry, not last, there's life insurance coming up. Cash at bank, it's got to be the simplest asset there is. Remember, only Form 3520 would need to be possibly FBARs and Form 8938 as far as FATCA is concerned. That may need to be filed also, but cash is simple. Cash is always held at par. There's no capital gain on cash. It's a post-capital gain asset. Life insurance outside of super. So what do we have here? Really, it's almost the same as cash in a way. It's not going to get taxed by the US or Australia. It could, however, if there was an investment-linked component. That's very rare to see in Australia since was it 1986 they cracked down on that. So not impossible, but I've never seen it before. Very rare to see what's called cash value life insurance in Australia. So life insurance outside of super is pretty clean. So moving on to strategic estate planning for US beneficiaries of Australian estates. I think this is some really value-added information right here. So first we start with a quick reference chart comparing asset classes. So we're defining the situs of an asset. Real estate is going to be situs in the country that it's located in. So that's an error. Actually, let me just correct that. Situs in country where it's located. Done. Go back to the presentation. Shares and investments. They are non-US situs. Retirement accounts are non-US situs. US bank accounts. US or foreign situs depending on the form of the account. And life insurance is generally not situs to Australia either. US estate tax, when does that apply? That can apply on real estate above $60,000, but of course there's an estate tax exemption. The estate tax applies to these other assets as well, but not to life insurance. There's a step up provided on these various assets, but not to retirement accounts. We're looking at a 10-year distribution rule that applies there. And in fact, just mentioning that gave me an idea for another presentation. Maybe it's not of interest to the folks that are on today, maybe it is, but with how the rules have changed recently to do with US retirement accounts, it is so complicated as to the distribution time frame. Is it 5 years? Is it 10 years? Is it your life expectancy? I can do a presentation sometime talking about how inherited IRAs are taxed in the current environment. Okay, so strategy number one is asset selection and allocation. The idea here is to sell taxable Australian property prior to distribution. Now, that need not be during the beneficiary's lifetime, but as someone mentioned when they chatted in, this could be the estate, the deceased estate, selling the asset itself. Why would you do that? That would be a fantastic idea for something like investment property that would otherwise be held by a non-resident, which is bad news for a host of other reasons. But it's the primary residence, same thing. If someone's not going to be moving back into it, sell it and get the benefit of the Australian resident tax rate by using the trust itself. Maximize cash and non-taxable Australian property to non-residents. This can simplify compliance and reduce both Australian and US tax reporting and headaches. Residency timing, only leave taxable Australian property to a beneficiary if there's a realistic possibility of them becoming an Australian tax resident before sale. so they might benefit from lower tax rates. Just had a client, her mother died. Would you believe at 104, she had the flexibility to move from Minnesota back to rural New South Wales, be with her mum in her dying days, remain in Australia for the settlement of the estate, and is now done and is back in the US. Next, leave non-taxable Australian property like shares and managed funds to Australian resident beneficiaries. I don't think that's the worst thing in the world for capital event K3 to apply, because you're still getting the resident tax rates and someone is going to pay that tax at some point or other. So I'm not as I don't think it's such a big deal to leave the non-tap assets to Australian resident beneficiaries. All right, strategy number 2: testamentary trust structure modifications. So avoid these problematic trust structures with US beneficiaries by not naming the beneficiary as a sole trustee or appointer. The thing is, US beneficiaries can still be in these testamentary trusts. It's all to do with control, as the US defines that. So if you can make it such that you have a corporate trustee and other beneficiaries, then maybe having a minority US beneficiary in there isn't the worst thing. It may distribute, in fact, as intended. This, by the way, right here, this is where you want to talk to your international estate planner, because it's very complicated and goes beyond my knowledge on how to handle estate planning. An alternative might be, if you're not going to set up a US compliant Australian trust, then to simply make the beneficiaries and trustees of the testamentary trust Australian tax residents only. So the US residents inherit other property that are held outside of the testamentary trust. Strategies for super, so binding death benefit nominations. Many people don't realize this, that if you don't have binding nominations, then it's actually at the superannuation trustee. So some nameless, faceless person, probably in Sydney, has the ultimate discretion over who the beneficiary of your superannuation account is. That is a scary fact, unless you have a binding nomination, and even binding nominations can reset every 2 years. So it's something to pay attention to, who your super beneficiaries are. Consider nominating Australian residents for that particular asset class. Leave other assets to US beneficiaries. So we've spoken about this at length. There is, and this all speaks to that first point about the asset allocation, figuring out what the tax treatment is going to be by the tax asset class. Have your US beneficiaries receive certain things like cash, the primary residence? Have your Australian beneficiaries receive, or even better, your tax dependents receive superannuation and other investment assets such as investment property? And certainly a lump sum distribution to a US beneficiary of superannuation would be financially the worst thing you could just about do if someone was in a US state with state taxes as well, because it's Australian taxable, it's US taxable, and it's US state taxable. So a really bad outcome there. Gifting during a lifetime, this is certainly an idea as well. There's no Australian gift tax. The US is always happy to see money flow into the US. They want to know about it, though, to know that it's not going to support some untoward cause. So that's where the 3520 comes in. It avoids that CGT event K3 that we spoke about. And it reduces the estate size and complexity. I do an end of year private client event for Arete Wealth Strategists clients. Last year we did this book review on a book called Die with Zero. So this is a strategy that might be in keeping with that kind of philosophy as espoused in that book, Die with Zero. Disadvantages of this is gifting appreciated assets may trigger CGT in the donor's hands. Possible, maybe not. That is very interesting to think about with regards to investment assets like managed funds or stocks. What if you gifted that before death? Then that CGT event K3 never is triggered. I'm just musing, thinking out loud here in saying that. No family relationship rollover relief to foreign residents. Okay, loses potential for main residence exemption planning. I don't think you'd give away your main residence before passing because there'd be no benefit in doing that because it passes tax-free within 2 years anyway. Strategy 5, tax residency timing strategies. This is the idea that a beneficiary moves back to Australia to be there at the time of the inheritance. It's not as simple as just jumping on a plane, though, and landing back in Australia. You've got to really make it clear that your your domicile has changed, and that's to do with your center of interests. That's the term of art used when talking for tax residency planning. Generally requires 6 months of presence and a usual place of abode. So if you were renting an Airbnb for 6 months, not only would that be incredibly expensive, but that really wouldn't establish that abode. In the example of the client I mentioned, she had actually moved back to be with her mother in her final years, plural. So she'd been there for some time. She didn't just jump on a plane and head on over, the day after the funeral and say, right, I'm here now. I've got to be an Australian tax resident, and I'm ready to receive my inheritance. Doesn't work like that. There's more that goes into it with determining residency. Okay, partial. This is another one that I've seen also for an Australian client, Australian-based US citizen client of mine down in Melbourne, where the wife was the beneficiary of an estate, and with a couple $100,000 of inheritance made to her. And she just didn't want to deal with the 3520, the cost that was going to add to her tax return, the hassle. There was the ability to distribute this across years. So that's what we decided to do, is to split it up over tax years to avoid having to file that 3520. Lastly, we have a checklist for executors and advisors. So what are some things you might do if you, in Donald Griffin, who is an estate attorney that I've worked with in the past based in Sydney, as he said, if you want to be a good what's the word? Oh my goodness, I can't believe I'm blanking on this. But if you want to set up your estate in a manner that is going to transfer tax efficiently and without a headache to your beneficiaries, then these are the steps that you would follow. Identify all beneficiaries' tax residency status. So that is, you'd be clear who your US tax residents are, regardless of where they're physically located or where their domicile is. Doesn't matter. They're still US tax residents. Classify all estate assets into taxable Australian property and non-taxable Australian property. Calculate potential CGT event K3 liability. I would add in another step here as well. I'd say determine your financial needs for the rest of your life. You may want stress testing your financial situation. You may say, I'm set, I'm covered, I've got practically guaranteed income. My expenses are going to be covered in all but the most extreme of events. And so perhaps I could give away some of these K3 subject assets before my passing. That would be the best outcome. And of course, review superannuation beneficiaries, confirming binding nominations, tax dependency status to know how much is actually going to go to whom and what they might expect to pay in inheriting that asset, and then calculate the death benefit on life insurance payouts, because folks may not get what they thought they would. Consider selling non-taxable taxable Australian property assets for distribution, or gifting them, as I just mentioned. Structured distributions to minimize Form 3520 filings and obtain foreign resident capital gains withholding clearance. That applies to real property transfers, as that question came up earlier from Ron. So that would avoid the automatic 15% withholding, but you're still going to pay the tax. There's no getting around that. It's just administratively a little bit more convenient. Post-distribution assessment. So provide your US beneficiaries with documentation on the date of death values. That's going to help with their US tax basis. Cost-based information for K3 calculation, so that the executor is able to figure out what needs to be paid to satisfy the amount due to the ATO for non-resident beneficiaries. Foreign tax paid just note what taxes have actually been paid in case there's an ability to pick up a foreign tax credit. And trust tax returns and distribution statements. Be sure to make those available as well. And then for US beneficiaries, of course, don't forget your 3520s for distributions in excess of 100,000 US dollars. FBAR's foreign account reporting, Form 8938 for FATCA and Form 8621 for PFIX, where they may exist. So practical, sorry, I said lastly before, this is the last section right here. Practical difficulties Americans face distributing an Australian estate. These are kind of generic. This would apply in either direction. Large transfer issues with foreign exchange, getting the most money for your money. We would recommend for clients, we use Currencies Direct to get a rate that's less than half of that, of WISE. So that's one way to save some money. Limited cross-border experience, finding advisors and CPAs and estate attorneys that know about this stuff. Very, very, very few of us around. In fact, I could name the experienced professionals on one hand. Estate administration delays, it could take a very long time if one was using their Australian will to administer the distribution of US assets because of probate needing to be granted in serial, not in parallel. So it has to first be granted in Australia and then it could be granted in the US. Better yet, have a US will for US assets, have an Australian will for Australian assets. Tax filing requirements, the horribly complicated forms, and heavens forbid if there's a PFIC involved in your situation. Another one, which is more of an issue of the information age, is online platform restrictions. You can find geo-blocking. It can be difficult to access Australian sites from abroad. It can be difficult to get things signed and processed and communicate during business hours and so forth. So the better your heir or future heir is in setting up their estate, then the easier they're going to make all of this stuff. Key takeaways here is planning ahead, expect delays, budget for costs, and consider alternatives as has been reviewed throughout this presentation. So next month, I'm going to be talking about another oldie goldie topic that always gets tons of attention. And it's to do with superannuation and how is super taxed in going in, doing a deep dive on this topic with flowcharts and so forth. How is superannuation taxed for American tax residents? And that's Americans in Australia or Australians in America who intend on receiving their super distribution at some point in the future. So that's going to be on Tuesday, November 18th, always the same time, 5:30 Pacific, 8:30 Eastern time, which is 10:30 in Brisbane, 11:30 in Sydney and Melbourne, now that we're into the daylight savings months of the year. So any questions, concerns, or doubtful points that anyone may have here on today's call? Now is your time. Or have I left you all spellbound and just on the edge of your seat? Still confused. Okay, well, that's what questions are for. Thank you, Jenny. I appreciate that. Thank you very much. I still remember our dinner in the Valley a couple years ago. Just giving folks a second here to write in with questions. I don't see anything popping up on the Q&A either. I think that's probably right. Carmel writes, do we need a US will for cash only? It's a great question. Many banks actually will offer you the ability to have what's called a TOD, a transfer on death instruction, attached to the bank account. That is helpful when you have US beneficiaries. If you have non-US beneficiaries, it won't work because they need a social security number to make that distribution. I would suggest you, if for more information on that kind of question, take a look at the webinar from 2 months ago to do with Australian beneficiaries of US estates. So it may be needed, Carmel, to answer your question, it may be needed for non-US beneficiaries of US cash accounts. Ron writes, is the 50% withheld for non-tax residents for income tax? Because on what asset are you talking about, Ron? I'm not with you. Is the 15% withheld for non-tax residents for income on what income? From what asset? Because no CGT is due. An inherited house. No, I don't think so. That's one, I believe I mentioned that earlier. Double check that, but I'm pretty sure that the residence, the main residence, is transferred without that withholding. Nancy, as usual, an informative session. I'm looking forward. I'm looking to move in early 2026. All right. Good for you, Nancy. We'll see you back here. Andrew, as a non-dependent, I pay 15% plus Medicare and lump sum distribution of a super account at death. Correct. And you're saying that because these were super funds initially, even though they're now distributed as a cash payment. Yes, correct, Andrew. That's right. It is a shocker. I would look at not distributing in a lump sum. The one bone I could throw you there would be an international CPA could really earn, yep, it is awful. It could really earn their fee because there's still maybe a way for you to establish a US basis in the superannuation account. Beyond my expertise, that's why I said a CPA, but they've got ways to say, well, actually, the full basis of that account isn't the terminal value in the account on the date of death. It's something less than that, but it's not zero. So if they can boost that taxable basis to something, then they're really justifying their fee in making that case. All right, excellent, everyone. Thank you. Have a wonderful day, and I will hopefully see you next month. Please don't keep me a secret. If you know anyone in your network who could benefit from our services, then I just ask that you pass on my name and website. Thank you very much.